time came when the ticker tape in the broker's office told a new story. It was panic. 16.5 million shares of stock sold in a single day.
Let's go, ladies and gentlemen. Welcome back to Stock Trading Me, the number one podcast for the investors in the stock market for beginners group on Facebook. Let's have a big room of the number one podcast from home. His first live. Let's go. We got people calling in from California.
California. Nice.
Let's go. We got peace and love in the house. Let's go, ladies and gentlemen. Of course, you know who I am. I'm Phil Better, the podcast mogul, but you guys don't here to listen to me. You are here to listen to the wisdoms of our two hosts that we normally have. Unfortunately, one is out. Tony is currently just relaxing with his baby that is a newborn, and we're wishing him all the well there. But today we have Dalt in the house. Dalt,
Hey.
how are you doing, and how is everything over at Banting Corp Capital, where you're an advisor?
Good, man. Amazing. I actually have to go to the office after this video, most likely. So late time works. But yeah, it was a good week. Started off Monday really well. Closed out a put on Uber on Monday and traded some USD CAD on Sunday into Monday and made just about $600 on that. So pretty good. So pretty good start to the week. So Monday made a whole bunch of money and been kind of carrying flat since. So
there we go. We got some other people first time seeing a full live. Let's go, Brian. He got the last half of our last one, and then we got Dorothy up in the villages in Florida. Hi, Dorothy. Thanks for tuning in. We love seeing you guys here. And if you guys who are listening to this, the podcast, if you guys want to be a part of the fun that we have here in the group, make sure you click in the show notes, join the group, become part of the family. We are here to help you guys make money while you invest. So it's always great seeing you guys live here all the time. And we're open and honest about our investing. But Dalt, we have some topics we want to talk about. And yeah, let's start with the first one. Do we want to touch on the cheap and expensive stocks, or do we want to talk about maybe something else that we got going on? You know, maybe the Fed and the interest rates, because we hear that's moving up.
It's all on the agenda tonight. It's all on the agenda tonight. So we'll start with whatever. It's all important.
Let's go with the Fed and the interest rates, because I've been hearing a lot about like what's coming up with the Fed and all that stuff in the industry. So let's talk about the Fed and the interest rate.
Yeah, so there was no interest rate movement today. We had Canada had their interest rate decision today too, and there was no change in Canada. That happened at 10 a.m. and there's no change in the U.S. that came at 2 p.m. So I don't know, like coming into today, overnight and early this morning, I kind of felt like Canada was going to raise interest rates, and I knew the U.S. was not going to raise interest rates today, but I kind of had a feeling that Canada was going to raise today and kind of beat the U.S. to the punch. So that was not the case. They both didn't raise, and it's all on the table now. So the chances of an interest rate hike between 0 and 0.25% today was 98%. So they leaned on the 0% movement rather than the 0.25. But coming up in March, the bets for a rate hike in March are 99% probability that it's going to be between a 25 basis point and a 50 basis point rise. So it's guaranteed to rise at this point in March for the US. And I imagine Canada will follow suit if that's the case. We'll see. But that's how we're looking. And so that happened at 2. And then so there was no change, and that was kind of bullish for markets, because markets were like, oh, I guess interest rates aren't rising as fast as we thought, right? We should be getting interest rate hike right now. But that wasn't the case. The markets kind of rallied, and then the Fed came out and had some more words for the pace of consecutive rate hikes moving forward. Kind of really sealing the deal that there was going to be a March rate hike, and pretty much at every other meeting after that. So that news came in, and that spooked markets, and that's kind of why the market crashed there within the last hour and a half. So yeah, it was a very, very crazy day, because markets were up all day long. So
Yeah, I heard about that, and just I was going to actually bring that up because Dorothy was asking, what do you think caused the drop in stocks after the announcement? So,
there was an
uh,
update. There was an update. Yeah.
yeah, the update. So you answered it even before she had. So there we go. This is how great Dalton is. He answers questions before he even knows they're coming, and that's why we like to have him on the podcast. So we are getting rate hikes. They're coming. It's an inevitable, and it's going to hurt a lot of businesses. Is that what we're kind of saying?
Oh yeah. Well, the businesses are one thing. It's going to hurt you too with your credit card minimum payments. So interest is going up everywhere. A lot of that has already been priced in too. So, but the first one's been priced in. So as they come down the line, every debt that you're carrying is going to get to be just a little bit more expensive,
Heavy.
right? So, interest payments are going up on your debt. Expect that to happen. And that's just the way the cookie's gonna crumble. So you're getting a lot of people selling right now, stocks, crypto. It's all the same. All that money people should have been using to pay down debt and to cover the basic expenses during the pandemic. They didn't use it for that. They used it for speculating heavily in the crypto markets and stock markets. So now that money is being called back in at a loss, so that they can go fund their basic expenses. And also in another article I wrote, I talked about how they had the largest increase in credit card debt in November of last year, and that data came out first week of January. So it was the largest increase in consumer credit and the largest increase in credit card debt. So with that being said, I think it was a $40 billion increase. So with that being said, Americans are really, really under the gun and relying heavily on credit to make a lot of purchases. So I think the consumer is a little cash strapped, and people are taking back their money out of the market to help fund for those expenses. So it's getting really tough. And that's the things that happen when interest rates rise, right? You think that they're going to be low forever. Your minimum payments are going to stay the same forever. No one really has the foresight of, to say, hey, well, as interest rates rise, my debt's going to be getting more expensive. And I think that's kind of really hitting home in 2020, 22, that your whole life is going to be getting more expensive. If you got to refinance a mortgage now, again, when you go to refinance the next couple months, and don't think that just because the rate hike is coming in March that rates haven't gone up on mortgages. No, they've already been going up. They've been going up in December. They're going up in January. The banks aren't waiting for the interest rate hikes to happen, right? They're anticipating. So everything is getting more expensive. It's pretty crazy.
This is amazing, Dalt. Again, before I even have the chance to ask, Tim's over here asking, and thank you for being live here, Tim. How drastically will the Fed rate increase affect the housing market? And you're already answering those questions before they even
Yeah,
popped up.
exactly. There you go.
And then we have another person. Give me a second here. I'm just going to pull up your name here. We have Brian here going, largest increase in credit card debt. Maybe I should invest in a credit card stock like MasterCard, like you're invested there.
I own MasterCard, yeah.
There you go. And just proving the point, find those market leaders, invest in those companies, and you'll see yourself win in the long run. Remember, guys, it's the road to wealth is a marathon. It's not a sprint. So you want to take your time over time, and you'll win and outpace everybody else, just like Dalt has done for his clients and Tony has done for himself. And I'm slowly doing as well as I learn the ropes of investing from these two great people. And you guys are too. Moving on, we let's touch on the difference between a cheap stock and an expensive stock? Like, is this the same thing as like choosing a wine at the liquor store? Or is this something more dangerous that can hurt us?
Well,
Can we
yeah,
get
I
into
mean,
that?
there's everything's fallen. I think people understand that there's price discounts, but not everything's at a discount. Tesla's not at a discount. AMC is not at a discount. There's a bunch of other stocks that aren't at a discount, and people are buying them up anyway. These stocks are still very, very expensive, and there's things that are trading at supreme discounts. Like Facebook is getting very, very close now to falling under trading at 20 times earnings. With so if Facebook's trading at 19 times earnings and they just grew revenue at 35% year over year, it's kind of foolish. So because you make your money back very, very quickly by just being invested for a few years. But there's lots of things like that. Like a lot of your big tech is still really, really cheap. I think Microsoft, Amazon, and Microsoft are the two most expensive FANG plus Microsoft stocks. So, but Apple's sitting really cheap because they grew revenue huge last year. Google's sitting really cheap. Facebook is sitting really, really cheap. So there's a lot of these companies out there, and basically the big difference that I look for when I'm trying to decide what's expensive and what's not, you don't look at the price per share because doesn't matter. What you look at is you kind of relate the price to earnings ratio with the growth of revenue and profits at the company. So if your rate of percentage, my rule of thumb that I've used, and I've used it and it's been pretty good. If the company is growing revenue at a higher percentage figure, and the company is growing profits at a higher percentage figure than what the price to earnings ratio is, which is basically the multiple of earnings. If that is growing at a faster clip, what you're going to find that these companies are going to be undervalued. And then you have companies that are, say, trading at 800 times earnings or 400 times earnings, like Tesla, and they're only growing revenue at 40 to 50% per year, which is still huge. That's very huge. Facebook's only doing 35. But there's that huge gap, and that huge gap between the revenue growth and the profitability and the price to earnings ratio is kind of where that fluff sits. And so some companies have a lot of fluff, and some companies are, it's only going to take exactly. So if Facebook's price stayed the same today, it would take you 19 years, because you're trading at 19 times today's earnings, to make your money back. But if that company is growing at 35, is constantly increasing that at 35% per year, well, now you have to subtract that from the 19 years. So really, you're looking at 10 years or less to actually make your money back. So it shortens that kind of time period where you're going to be making money. And so companies that have like a huge fluff in between that, like it just takes you longer and longer and longer and longer for you to make that, to actually get back to that cash position. And the thing is the higher that price to earnings ratio goes, the further out you're actually paying for earnings. Like people are paying like Tesla's earnings like 300 years from now, like after my grandfather died, after like my grandchildren die. People are paying for that valuation so far in the future, where we don't even know if there's going to be electric cars that far, right? Who knows what could happen? So the whole landscape changes. So you just got to find those companies that, like I said, are growing revenue at, it's very important, growing revenue at a faster clip than figure than the price to earnings ratio. When you start to see companies like that, they tend to be undervalued and they tend to hold up very well. And over time, those tend to be your biggest growers. Like I made the example too of Amazon. Someone thought Amazon was cheap, and Amazon only grew revenue by 19% last year. So in 2021, they grew revenue 19% from 2020. So that's good, but they're trading at 54 times earnings. So they're trading at more than double the price to earnings ratio of Facebook, and they have almost half of their revenue growth. And then their profitability is significantly lower. They have like a 5% profit margin versus Facebook's 35. So I asked the question of why would you be paying more money, 54 times earnings, for a company that grows revenue even slower with less profitability, when you could pay 21 times earnings and get a 35% revenue growth and a 35% profit margin. And that's the kind of things that you want to look for, because Facebook has a lot less fluff in it than Amazon does. Amazon has a bit of fluff there. So, and when you have a bit of fluff, fluff, again, it tends to hold up in a bull market when things are bouncy. But when things get tough and interest rates start rising and money becomes more expensive, the markets tend to shrink that fluff and bring it back more into evaluation. So I think Amazon will get hurt a lot more from this point forward than, say, a Facebook, Apple, or Google.
Just knowledge being dropped here. Just knowledge. Anything else you want to add to that? Any questions? I know we have some people here who just said that Brian just bought some Facebook and some Google today, which is
awesome.
a smart play.
Awesome.
Jolt is a big fan and proponent of the Googles, and of course the Facebook, because that's where we are live, building this amazing community of investors and listeners to the show. And if you guys go to our YouTube, actually, go to the YouTube channel. The link should be in the show notes. You'll start seeing the videos pop up now. The videos will be popping up on a regular basis, few and far between, but every week there will be at least 1 to 2 new videos popping up there of previous and current recording of the show. So you guys can go check out that. How long is this live? We got it's usually about an hour. We usually go about 45 minutes is the minimum we usually go. So you can go that. You can always watch later, Mitch.
Yeah, they're always posted in the group.
It's always posted in the group, so just bookmark this page or whatever. You can ask, where is the link? The link will be in the show notes. If it's not there right now, it will be after the show. I'll have it, and it will be in the comments. No worries there. We got our boy Mark shouting out from Tony's backyard. Please be careful there. Don't break down his door. Let him just relax there and enjoy. No reason to apologize, Mitch. We love answering those questions. That's why we're here. This is the reason we do these shows. It's to help you guys. So the questions are appreciated, and we will love answering all those questions. Regarding stocks and all that, we'll take it a bit at the end. So if you have questions regarding specific stocks or situation like that, we'll answer at the end. We do have a format we want to follow. We have some topics we want to touch about, get you guys educated, and we're loving the interaction. Thank you so much for letting us know you're here and enjoying. So ask questions away. But Brian, yes, I do agree. Mark should babysit, but I think Tony's enjoying being a dad for right now. So yes.
I'm going to talk a little bit about NVIDIA there. Someone asked, and NVIDIA is an interesting one because there is fluff there. There is some fluff, and it's because NVIDIA is trading at 70 times earnings. But the interesting thing about NVIDIA is they grow revenue, or they have been, not always, they have been growing revenue at 60% per year, at least for the last year. And so when you're able to grow revenue at 60% per year, you can justify a higher price to earnings multiple, because as I said, is it really that big of a deal to be trading at 70 times earnings if you're doing 60% of revenue year over year? So you're getting very close to that upper level of being able to double your revenue year over year. So because of that high revenue growth rate that they hit because of cryptocurrency miners and these sorts of things that are doing NVIDIA all kinds of favors, and then the semiconductor shortage, these things have done them all kinds of favors, and so they've been able to raise prices pretty effectively, and their profit margin also went up. So that's another good thing. So that's why that company has been able to support that high valuation for a period of time. As these price pressures ease, these price pressures on semiconductors and GPUs ease, and as supply chains get back to normalization or some normalcy, you'll see NVIDIA's revenues start to dip and slow down, and their profitability will start to taper off a little bit. And that's when you'll see that price to earnings ratio start to come down a little bit, because of course, if you can't grow revenue at 60% every year, you're not going to be trading at 70 times earnings for very long. So it was justified because of the rapid pace of they had as they were growing. Again, there's a little bit of fluff there, but not as much as you would think. So again, 60% revenue growth year over year, trading at 70 times earnings. There's actually less fluff there than there is Amazon trading at 19 times. Growing revenue at 19% year over year, but trading at 54 times earnings, right? So well more than double there. But 60 to 70 here for NVIDIA, there's a lot less fluff there than you would think.
So Brian is bringing up when Brian and Jerome are appreciating the answer, but Brian is bringing up he's liking NVIDIA long term for their AI technology and what they are building their own metaverse called the Omniverse. That's going to be interesting.
Interesting, yeah.
Interesting. Didn't read about that, but okay. And then we have Mark, our fellow stalker of the Tony, asking any thoughts on what entry point you're looking at getting back in at the moment.
For me,
I'm guessing it's you because you're the active investor. I'm not.
I'm in the market. I was going to get out if Biden was going to remove Jerome Powell next month, which will be, I think, it's the first couple of weeks, sometime in the first 11 days, I think, is the Fed chair appointment. From what I understand, it's almost a guarantee that Jerome Powell is going to be staying on. I'd be very fucking upset, excuse my language, if Biden takes him out and markets, just fall through the floor. I'll be pissed. But from what I understand is he will be staying, and I do like his relatively accommodating monetary policy. I think Powell is great for markets. He's the markets guy. Trump put him there, and he's just done a good job. So I like his job to be able to support markets and do what is needed. Again, this is a guy that, for the first time ever went in there and bought bond index funds. Like no Fed chair does that, but he did. So he's done a lot of unconventional things to support markets in their time of need last year. So I really like him, and I think he's great for markets. And as long as he's there, I'll still be in the market. So I bought Facebook earlier this week. I bought $1,000 more. A couple weeks ago or last week, I bought more Google and Facebook as well. And I dollar cost average into some of my lower positions. And I'll continue to buy things like my next buys, if I'm buying anything, will be again Facebook, because it's just it's sitting way too cheap in my opinion. They made over $100 billion worth of revenue last year. They're the only company that can make over $100 billion of revenue and trade at less than $1 trillion. Every other company that's trading over $1 trillion, except for Tesla, but every other company, Google, Facebook, Amazon, all these companies that make more than $100 billion in revenue per year, all trade over $1 billion. So, $1 trillion, and Facebook is sitting at 800 billion market cap. So, kind of silly. So I'm betting on that with their strong profit margin that they should be $1 trillion company. I've always said that they should be, and I think the time is coming. It's inevitable. So I'll continue to buy them until they get to a point above a valuation of $1 trillion.
There you go. And if you're looking for it, I did just drop the link of our YouTube channel in the comments. So, and it's pinned to the top. So you guys can click on there, subscribe, and check that out. We want to try and we have 50,000 members in this group. If we can get 1,000 people liking our YouTube page, that means we can
like it.
Or subscribe, and then just watch 1,000 of you watch 40 minutes of our episodes. We're already at 36. So there you go. We start getting paid, and then we can put into place some plans we wanted to do on the show that we've been talking about. So, all right, Dalt, we're going to move on to our third topic.
What do we got?
We got trading options and other markets.
Trading options and other markets.
There you go. Go and subscribe. Thank you so much for the love and support there. What we got here? Where our new crypto coin? It's coming, Mark.
Once we monetize our YouTube, it's coming right down the pipeline.
Yeah, there you go. That's why we need you to subscribe. Yes, go subscribe. Get YouTube to pay us, and then I have the connections to the people that can make us the coin, but they need the money first. So we want to do that so that you guys can have that crypto coin and crypto monetization and
There
help
you
us
go.
subscribe and be some of the first. So go over to the YouTube channel and subscribe. I want to see that you guys are just blowing up, and watch the videos that are there, and keep make sure you hit the bell and icon and all that fun stuff. Anyways, Dalt, trading options and all that. So
Yeah,
sub to the oh wait, we got
this is
some other.
a big topic. So a lot of people in the group are talking about this, like uh everything's going down. Should I sell out? Some people are already in options. Some people are doing special option strategies, cover call strategies, uh, call spreads, all this type of stuff. So yeah, so trading options. So you can make money. You can make money in the stock market going up, and you can go down. We publish signals at Banting Court for stocks that are going that we believe are having upward momentum, and we publish signals for stocks that we believe are having downward momentum. So and again, I trade my own signals. The one that I sold, the Uber put that I sold on Monday, that was one of my signals that I sent out to the subscribers. So again, stuff falls, you can profit. Stuff rises, you can profit. You share in the profits of a stock that's rising with call options, and you share in the profits of a company that's falling with put options. So so puts are always something that you can use either outright on companies that you believe are supremely overvalued, like Tesla, like AMC. You can slap a put on them and watch them fall pretty easily. And you could also use it to hedge your most speculative positions in your portfolio. And I actually do that. And again, I published another blog article on that a few weeks ago called Advanced Portfolio Management Techniques. So if you go to the bantingcourtcapital.com blog and you just search the word advanced on the blog, you'll find that article will pop up. And it's basically you hedge that short-term risk in your most speculative positions. So I have them on DocuSign. I have puts on Teladoc. Even though I own shares in these companies, I have puts on these companies so that I am removing that short-term risk. So as long as these companies are going to fall in the short term, I know they're good businesses. They make money. They raise revenue every quarter. They raise profits every quarter. I have no problem holding them long term. I don't see any reason, anything bad with the business. So what I do is I throw a put on it. It goes down. Great. Continue to go down and go down and go down. I'm laughing anyway. And because of the leverage that you have in options, what ends up happening at a certain point is you'll end up making more money on the option put itself than you lost on the value of the shares. And so if it's even, they call that net zero. So the profit that you make on the option versus what you lost on the stock itself, if you're hedging, if that's equal, that's called net zero. You've eliminated any downside risk because you have the proper put. And then you can have a net profit too, which means you're making more on the puts when the stock is going down than you are losing on the shares. Because of the leverage, it can work like that. So so you can really, like, again, these are advanced techniques that people are going to use or not use, again, up to everybody's discretion, how talented they are at trading options, whether or not they understand the derivative product. But ultimately it's up to each individual to learn how to hedge and learn these things. And that's why we publish articles on, things to get thinking about, things that you can do to hedge your short-term risk. You can do that stuff. So you can throw puts on, like I said, stocks you don't own, or you can hedge your existing exposure in stocks that you own, right? If you believe that what you're holding is a long-term play and you're just done with this market downturn, but Microsoft or Facebook or Netflix, Netflix is going to come back. Then you can get the shares and you could throw a put on it, hedge that short-term risk, and that way you sleep well at night, right? So a lot of people saw, and I know there's a pending post I saw from Clisson about Bill Ackman buying Netflix. He bought up 1.2 billion worth of shares. So and I posted on somebody who asked on a different thread who asked about Netflix. I said, well, Ackman just bought this, but I'm sure he's hedged. So he'll go in to buy the shares because they're attractive at this price, but there's still some downward momentum lying there. And so I'm sure he has a put. So the Wall Street guys do the same thing. They'll buy the stock because it's attractive. They'll throw a put on in the short term to hedge their short-term risk. Once, markets start to move higher, they'll sell the put and they'll just hold the shares. That way they don't lose anything in the interim. So again, these are advanced techniques that a lot of these guys use. Nobody likes to lose money. and there's a bunch of ways that you can hedge. So options are one of them that you can use at your discretion if you feel that you want to hedge. So that's one thing you can do. Everybody knows as well. I've been talking and pretty vocal about it. That I'm also trading currencies and commodities, oil in particular, and by currencies only the U.S. CAD trading pair. I'm not going to recommend that anybody even look into doing that. Totally different market, but sometimes, like the more you read, again, read a lot of books. I have a lot of knowledge bases on my blog of things you can learn about futures and trading currencies, forex, all that stuff. Watch the content. There's videos, there's books. Inhale the content. The more you learn, the better you'll get at it, and you'll learn there's relationships between stock markets and currencies, and stock markets and oil, and currencies and oil, and it's sometimes these other markets get easier to trade than the stock market. So just to build a good, well-rounded knowledge base, you should learn about other markets and how other markets interact, because sometimes there's easy trades that you just go pick up, fill your bucket, and walk away. Other times there's trades like in the stock market right now where it's hard to make a dollar to the upside, and that's true, it is. But currency markets, it's pretty easy. Oil's just been on a tear, like it just goes up, and it's going to continue to go up unless Biden does something. So easier markets, but you have to learn. And I think learning to trade other markets and certainly use options are definitely important for a well-rounded portfolio.
There we go. We got something. We already have so much questions popping up.
Hit me with them.
Yeah, I know. Give me a second here. You just drop like knowledge bombs on knowledge bombs over here. I'm still digesting it. Jesus, my brain. And but it's true about what you were saying with the ingesting the knowledge, getting the knowledge, and reading. Your blog is one of the best blogs I've started reading out there on investing, because it's such a it takes it so that even if you don't have a lot of knowledge, you break it down so it's easy, but it's also complicated enough for people who are a little further along than the average normal investor like myself and some members here.
Exactly.
Like, and you were saying, like, Dorothy mentioned that she barely understood invests and puts and calls and all that, and it's like heading over to your blog is probably one of the best places to start, because you have such a wealth of knowledge there on that. Plus you have the resources out to other people who are maybe a bit more knowledgeable that you can get information from. So I would suggest the best thing is to start at Dalt's blog at Matching Corp Capital. It's the link. It's in the link in the show notes. Go start there, and you'll have a great thing. We already got some people here. Our good friend Mark is shouting you out, saying you're freaking awesome, Reed, and he appreciates it. And he actually was asking, I guess because we mentioned commodities, he was wondering, do you see oil hitting 100 a barrel?
I don't know. I see oil continuing to go up unless so Biden's already tapped the strategic oil reserve. It looks like, but you tap the strategic oil reserve, so oil reserves are sitting there, right? So you have however many they have, say 200 million barrels.
Yeah.
So that's oil that's sitting there, right? It's a surplus. It's a supply that sits there. But when you start dipping into it and start taking 1 million here, 2 million here, 5 million here, so that's a total of 8 million. If you had 100, now you only have 92. So now there's been a draw on your oil reserve. So now there's even less oil that's sitting open in the market. So now the price of oil continues to go up. And so the kind of issue Biden's facing is, and people don't like to make it political, but it is political. The reason why oil is going up, so oil was dirt cheap under Trump, $20 or 19. Reason for that, because he drilled the hell out of the Permian Basin. Like, the U.S. was the top oil producer in the world, and they weren't when they started before Trump. He made a point of keeping oil prices very low, and if you want to keep oil prices very low, you got to build a huge supply. So you got to drill every day, find new oil every day, and bring new reserves to life. And the more oil that you bring out of the ground, the cheaper existing oil above ground gets in your oil reserve, in your refinery, in the holding tanks. The cheaper all that stuff gets, the more that you pour on top of it. What Biden did is Biden said, no, you guys can't drill wherever you want anymore. There's drilling limits. You can't explore for new oil. You can't drill here. You can't get that Arctic drilling job either. So now the amount of oil that people are pulling out of the ground in the Biden presidency is a lot less. Is it healthier for the environment? Of course it is. But it's also going to put the upward pressure on the price of oil. So the price of oil goes up. Gasoline is now at all-time highs because you're not pulling oil out of the ground. And if you don't pull oil out of the ground, the existing oil gets more expensive. And so it's all political. So again, better for the environment, but worse for your wallet in every single way. So again, that's the trade-off. So Republican presidents are very good for low commodity prices. Democratic presidents are typically not. So as long as Biden continues to go business as usual with what he's been doing, oil could certainly hit 100 and go right past it. If he's going to allow, and I think he did. I read an article, I think, of the Wall Street Journal last month or earlier this month. And I believe it said that Biden was looking at easing a lot of mining restrictions for oil. So he's going to start to allow oil producers to drill more wells, look for more oil, and pull more oil out of the ground. That would be great for putting downward pressure on the price of oil, which would put downward pressure on gas prices. So if he does that, and you see, like, again, look at the Baker Hughes rig count. That's one thing you can look at on the economic calendar to see what that rig count is. You see rig counts going up. That means obviously there's more drilling. People are putting more rigs to work. Track stuff like that. U.S. oil inventories come out on Wednesday. Keep an eye on that kind of stuff. If you see inventories building, that's a good thing for putting downward pressure on the price of oil. If you see inventories declining, and rig counts declining, that means there's less oil, less drilling, upward pressure on the price of oil. So those are two things that you're going to watch out for.
Just freaking knowledge on knowledge over here, dropping them like bombs. I love it. Dalt is so effing smart, man. I aspire to be like him one day, and it's just start small and just learn. Start reading Dalt's blog.
Read. That's all. Yeah, I just read a lot. Yeah,
that's what it is. Let's see. We got some other thing here. We got where is it? Someone's asking what else they can do. They sub to the YouTube. You can go over to Instagram at Stock Dirty Pod is our Instagram. Go ahead and like that. We have a Facebook page. Go ahead and like that. Stock Dirty to Me Pod. You can find it there. Be very thankful for that. We'll touch on DraftKings in a bit. That was mentioned. I think there was someone else mentioning a crypto something. No.
Is my blog free to read? Absolutely.
Yes, Dalt is 100% free. Head over to his website. Oh, yes, I remember what it was. It was, do you guys put calls and puts? Where is that? I think I saw someone. I lost it. Oh, well. There was someone was asking if we, yeah, here it is. Do you guys do calls out on good puts and calls? I want to make some money. You have your algorithm, right, for your clients?
I do. Yeah, I do. So
yeah,
we do publish long and short signals for stocks, and they're typically, the majority of those signals that I give are all for how we trade them, and it's most often always an options trade. So if I get a long signal, of course, say look at it this way: I get a long signal on Johnson & Johnson at $67. I'm probably going to throw a call on it, and I'm going to call it at 70. So if that gets to 71, I'm going to make a shitload of money, like 20 to 50%. But if I only bought the stock itself, I'm going to make like 3-4%. So that's the reason why I use options, is because the price movements are rapid and they're short term. And so the best bang for your buck is definitely in the options market, over just buying the stocks outright. So when I publish the signals, the way that we trade them is options, and I give you the exact options trade I'm doing, exact contract, expiry, strike price, the premium that I get in at, the take profit. I tell you when to buy, what level to sell. If nothing happens and you just trade flat, I tell you when to get out. So it's like I have the whole thing, the whole trade management thing all done for you. And yeah, we publish, we go long, we go short. Like I said, we'll get puts if I get a sell signal. I'll buy calls if I get a long. So that's the way that it works. And yeah, we also have signals for FX, the USD CAD trading pair, signals for US oil, and we just added signals for cryptocurrencies on Sunday. So we have all of that. The cheapest one is the stock signals right now, which are $12 per month. So it's like I said, the stuff works, so I don't charge a lot for it. It just covers cost. I don't need to kill you like those Discord guys, $100, $200 a month. It's ridiculous. The algorithm works, so I make money anyway. I don't need to make money off people. So
there we go. And then we got here. Seems like the fear index has been high the last few months, and it's been an easy option lately. Am I a fool because it's seeming too easy? No. If you're doing it smart, you're not. You're not. You're being smart and you're making money because it is simple. It's not necessarily easy. It's over time you learn this. And $12 for an algorithm. Yes.
are you referring to the fear and greed index, or like
I think
the
he's talking
VIX?
about your algorithm and that your calls and puts and that. Yeah, because after he goes, how to get access to algorithm. Well, go over to the Bantencorp Capital website.
Yeah,
Yes.
the VIX. Okay, so yeah, so two different guys here, I guess. So
Yeah,
for the algorithm,
Mark is asking about the VIX.
yeah, bandoncourtcapital.com is where you can get access to the algorithm under the subscriptions page.
Yeah.
The VIX, yeah. So the VIX, man, I wouldn't play the VIX itself. I would honestly, I would focus, because interest rates are rising and you're getting a lot of volatility now. I would focus on on putting puts on companies that are the worst performers when interest rates rise. So companies that don't make money. I saw someone asked about Lucid earlier, and they want to know what's going on with that. Lucid doesn't make a dime, so they're going to get crushed as interest rates rise, and the payments on all their buildings go up, and all the money that they borrowed goes up. They're going to get killed. Anybody that's not making money, anybody that doesn't have positive free cash flow, anybody has a high debt and a quick ratio under 1.0, these are the type of companies that I would start to throw big puts on, because they're going to go down, and a lot of these guys are not going to come back. So eventually you have to make money, and you definitely have to make money when interest rates are going to rise like 4 times in a year. So Powell's saying he wants to end the year at 2%. I can't remember a year we went from 0 to 2%. So that's pretty aggressive. So a lot of companies that are really hurting for cash and can't make money are going to get smoked. So those are the companies that I would try to focus on if you're going to be dropping puts.
So Mark is over here asking, I feel like anything Amazon can crush like a cockroach. Also, I'm not sure I follow that question of logic.
Yeah, what does that mean?
I think he feels like if anything, Amazon can crush anything like a cockroach, possibly.
Yeah, kinda.
It is cold where he is, so I can understand maybe the blood's not working too much to the fingers and that. So he's trying to limit the amount of time he has to talk outside.
Amazon's big, but they're not that big. Like they don't they're not as big as people think. Like people think Amazon's huge. They make 280 billion or 300 billion, 400 billion per year. They're huge. Walmart makes 600 billion per year. They have the most revenue of any company in the world. So people think they're so much bigger than Walmart. No, they don't. They don't do anywhere near the amount of business that Walmart does.
If Walmart fixes their online app, they would crush because they already have the trucking industry. They have their own trucking corporation. Like a good book you guys should read is the Sam Walton biography. Sam Walton's one of the guys who co-founded Walmart. But they have their own trucking company. Like, do you understand that? And they have warehouses in every town. Nearly every town has a Walmart. If they got their online game done, think about the delivery. Like they could destroy pretty much Uber. They could destroy everybody because they could create a network of drivers for them to drive everything. So next day delivery, forget about next day delivery. How about 20-minute delivery? Think about that. That could be coming if Walmart can organize something as straight as that. But anyways, yes, you were continuing,
and
adult.
and I think they'll do really well this year because if anybody's noticed, you go to the grocery store and all your big brands are gone, but what's sitting there on every shelf? Walmart's own Great Value brand, because Walmart doesn't have shortages. Walmart's Great Value is fucking everywhere. So you'll look at all the syrup is gone, but they got Great Value syrup for you. All the crackers are gone, but they got Great Value crackers for you. All the meat is gone, but they got a Great Value meat for you. So it's like everybody else, every other major meat producer is suffering because they're a lot smaller and their logistics aren't anywhere as good. Walmart can almost pull product from anywhere in North America and get it right to where you need it, and they're pretty efficient with that. But yeah, Amazon's big, but like I said, they only got $70 billion worth of cash on their balance sheet. So yeah, they're trading at a valuation of 1.3 trillion, but they got the same amount of cash as Facebook, who's trading at 800 billion. So they look big, but they don't have a lot of cash. It's because their margins are super thin. So they got a 5% profit margin. So although, they're getting 456 billion in revenue, wow, super big, they're only really taking home like 20 billion. It's useless. So again, Facebook's clearing, I think, 35 billion or more per quarter. Amazon's only doing like 20 or something like that, I think. Or no, 20. No, sorry, 20 for the year. 20 for the year.
Jesus.
Yeah, 20 for the year. And then yeah, Facebook is 35 billion for the year profits. So again, like Amazon has huge revenue, but their profit margins are so thin, and they don't really have a lot of wiggle room. And so, like when you see Microsoft buy things like Activision Blizzard and like all cash for 70 billion, Amazon could never do that. They don't have that kind of money. So they could, but then they wipe out their whole balance sheet and they can't pay any of their bills. So they're not going to do that. That's way outside of their realm. That's just like a drop in the bucket because Microsoft has hundreds of billions on the balance sheet. They don't care. So totally different story. They're not as big as they seem, and they don't have a lot of wiggle room should stuff get tight. And so this whole thing of Amazon selling products at a loss in this kind of environment, I think is going to weigh on them a little bit.
So I'm interested to continue this conversation about Walmart, and that Marcus jumping in here goes, what has Walmart done the last year? Though they are down because they don't pass the cost to the consumer and they don't care about their stock as much.
Yeah, I don't think Walmart
Walmart's going to be around for a long time.
Spectacular. I'm not going to look at the last year because 1 year is kind of transient. If you want to pull up a 5-year, I think that's better. That's a way better look.
That set up over here. Market Watch, right? And then I go to here.
I'm always trying to get my phone because my phone gives me the 5-year on the Yahoo Finance app. So 103% over the last 5 years. And what has Walmart
so
done?
I got Walmart. Let's go. I go all year. I can only do all. Yeah, look at this.
Over the last 5 years, VU has only done 89%.
This is
Walmart
where
wiped the floor with VU over the last 5 years.
Look at that.
You may not think it's doing anything, but it's beating the market. It's beating the S&P 500. It's doing a pretty good job.
Let's go last 3 years.
Again, like these are the companies that kind of fall to the back of everyone's mind. Everybody will go to Walmart 25 times per week and not even think about investing in it. Just like how they use Google 25 times per day and they don't invest in Google. It's one of those companies that's so ingrained in society and will be here for a very long time. And consumers don't even really, they just take it for granted. And they think that it's always going to be there. But if you took away Walmart, where would you get all of your shit? Think about that. Where would you get your stuff?
We got here because it's not flashy. Exactly. It's not flashy. Yeah. That smart investing is not flashy. It's boring as all hell. Lloyd has said it. Warren Buffett has said it.
Who wants to invest in Walmart when you can invest in drones and electric flying cars and all this crap? Who wants to invest in all that? Right?
I want to invest in a company that's making me money. That's what I care. I care about the long term, not the short term.
Oh, fuck Walmart. I just shop there every day. That's not a big
deal. Look at this. Look at this. Back in 2019, February 3rd, it was $95 a share. Okay. It is now trading as of the 23rd at $135 a share.
Yeah.
That is smart money. In 3 years, I made, how much money did I make, Belcher? $40. I made $40 in 3 years. That's more than $10 a year.
Yeah.
You know, like that's a great. I don't know anything that would have made me that money. $40
Amazon's done more. Like Amazon's got to be like 300% over the last 5 years. But what with that comes more volatility because there's a lot of fluff there. So you'll see this year though. I'll guess that Walmart kicks Amazon's ass. Now that interest rates are rising, there's no more free money. This will be a year where Walmart walks all over Amazon. So, like I said, you look like you just Walmart's not flashy. It's not going to make you 300% every 5 years. Amazon has the potential to do that, but Amazon's getting super saturated, and they got to look for growth internationally, markets that Walmart has already grabbed. Walmart's everywhere. Like it's not just here in Canada and the US. Like they're in a lot of places in Europe. They're all over. So you have to really weigh that. And so Amazon has to get a lot of growth now from Prime and online orders in Europe. That's the next big tackle. And if they can continue to grow at the pace that they have in the US over in Europe, then it will continue to grow. The stock will grow faster than Walmart. But Walmart's a steady Eddie. It's always going to be there. It's reliable. Revenue went up in the pandemic. It's one of those businesses that has to stay open because they have groceries there. They were very smart to do that. So now it's a staple, and they're just there. They're safe. You don't have to worry. You don't have to sweat. And you're not going to have these big drops like you're seeing in Amazon. So, it is what it is. To each their own, right? So,
wait, we got an interesting comment here from Mark going, Amazon sort of like Baba seems a very scary place to be in right now with all these hikes. Yeah, it is.
Yeah,
with these
Baba's
hikes,
scarier for sure. But yeah,
yeah, Baba's probably scarier. You're right, and
Baba's suffering from the noose of the Chinese government. Yeah.
But hey, they can rebound because they do control most of the GDP there. But yeah, no, it's going to be. Look, Amazon's going to get. Everybody's going to be. You're going to be a crunch, but Walmart is going to be there because their prices are so low. Consumers are going to continually go there, and they're going to make profit. And if they can get their set up a delivery system that is pretty much day of, like I don't have to pay Uber Eats. I can do directly on Walmart's app. I can order and it's delivered. It's going to be insane. It's going to be insane. Oh, wait, we got another question here from Jerome. And this will be the last one, and then we'll wrap up here. And this brings it back to the first question. Are you trying to be rich or wealthy? And everyone lies and says wealthy when they really want to get rich quick. It's very true. It's very true.
That's true. Man.
I want to get wealthy. I'm in no rush to get rich. I'm in no rush. I know real wealth takes time, and I'm building up the assets necessary to do it. And so that I will be able to live the life I want, which is financially free and do whatever I want. But yes, ladies and gentlemen, this is the show. I want to thank you all for watching, being here, interacting with us. We look forward to it every week. Dalt, how about you let them know where they can find you and get more of your incredible knowledge?
In the group, I still post all my articles every week in the group. There's one that we posted tonight as well, the Wednesday one. I'm just talking about the interest rate decision and what Powell sees going forward. Sunday's article that I post in the group will actually be about options trading strategies, so take a look out for that one. I'm going to actually break it down on how to use these things. So bantencourtcapital.com/blog. And on Instagram, I'm there as well. You can find me at RismayLife, RismayLife. On Instagram, live videos every Saturday. I do, and I share lots of Wall Street Journal premium content for free on my Instagram story. So if you want to scam the Wall Street Journal and you can't afford $10 US a month and you want to scam them, come watch my story because I post all their email updates. So there you go.
always giving value at all times. And make sure you guys don't come follow me. Don't worry about following me at Podcaster Phil Better on Instagram. Make sure you go to Instagram and follow us here at the show at Stock Dirty Pod. Let's get that up so that we can get maybe get some big wigs on our show, and you guys can ask some tough questions. I want to thank everybody for tuning in, interacting. Again, we love you all here, and this is why we do it. Tell your friends about us. And as always, guys, smart investing.